oil. And obviously, because we've got great value to sell oil into the top edges here, we can obviously start thinking about the overall shape of the trade. How do we get that great value into that top line? So obviously there's a couple of things we can do. If I put in a visible big sell order too early, what happens? If I put in a big visible sell order and there's not very many buyers, it's going to frighten away whatever buyers are already there, right? So you're going to get a big sell-off and we're never going to get filled. The sell's going to come in and the price is going to drop away from that price without even getting close to it at times. Now, the thing about liquidity is when you add liquidity, a lot of times it pulls price into that liquidity. But obviously that's only if there's a lot of buyers. That's only if there's a reason for it. So obviously this situation here of that sell depends upon what value is doing. So what I mean by that is if the value is going up, that liquidity is attracting the business coming in, isn't it? Because everybody's looking at that saying, well, that's going to pull. At some stage, that's going to pull. So it's acting as an attractor. Whereas if value is going down, it's acting as a repellent magnet, isn't it? It's acting to repel the same thing. So obviously what's going to happen is you'll get an exact opposite reaction, even to the same liquidity and to the same storyline. So in other words, what we try and always do is we always try and stack the order flow to the order flow to the value. If the order flow stacks up with the value, that's what we call a transition trade. That's basically Charlie D's trading 101, isn't it? Charlie D looks up at the big board, sees the yen's catching a bid, sees some bids coming in on bonds, decides to jump on board the bond. If he sees the yen going up and he sees some offers coming in on bonds, what are these guys doing? Are they trying to spoof some sellers to press down into the bottom edges? He sees the big buyer, but they're 5 ticks away, and he's going, okay, they're trying to pull the price down just now. Let's just give this a few minutes. So you give it a few minutes till that storyline evolves. So the context becomes incredibly important about what it is you're actually trying to accomplish. Because if you turn it around a little bit and we say to you guys, well, what would you do? In this situation up here, the value is building for the big sell. You can see that because that's what we tweeted. Short value as oil was starting to become more expensive and the crack spread is building value in the short sell. So the value is doing that. It's dropping off, right? The value is dropping out of this area here. So how are you going to get your trade on? So you get a phone call from one of the big players in the oil industry and you're taking calls and the guy says, sell me 500 oil. How are you going to get that short sell? Are you just going to hit the market with a 500 sell order? Of course you're not, because you're going to get absolutely annihilated if you do that. I mean, you're going to end up getting a fill of $78.60 trying to get 500 contracts filled, right? Possibly even worse. So there's no way you're going to sell 500 contracts as soon as that phone call comes through. So what you're going to do is you're going to test it. You're going to see how many you can get in. Usually what happens, the first thing that I normally do if I've got an order for 500 is the context. Where am I going to find? And that's the question, isn't it? If I want to be short 500, what is the question you must ask, Klaus? That's a question right there, isn't it? If I've got to sell 500 oil contracts, where am I going to find 500 buyers at a top edge? Where am I going to find 500 contracts? I know I could find 500 at a bottom edge because we know everybody always buys bottom edges. So we know we're going to find 500 contracts maybe down into this kind of price area here. We know we'll certainly get more volume, and you can see that there was more volume coming in these areas, right? So we know we can get that price. But have we just given away all our value at that price? That's the challenge, isn't it? We've given away pretty much all our value at that price. So we can do a few things. The first thing we could do is we could start bidding in this area to try and force the price up, because we know there's going to be buyers up here, right? We absolutely know there's going to be buyers up here because it's going to be the breakout buyers, it's going to be the momentum algorithm buyers, it's going to be the sellers getting stopped. We know there's potentially 500 contracts up here to sell to. The challenge is, what happens if nobody buys in that bid? What happens if you put a big bid in the market and nobody buys? In fact, somebody sells to you against your bid. So you're at this stage here on this blue candle here, and you're currently long 50 contracts because somebody sold into your bid. What? I've now got to try and find 550 sellers, not just 500. It's getting worse. So at some stage, that's why you have to end up crossing, don't you? We never got the 500 orders at the top edge. We never got any buyers coming in. So we just had to sell to whatever buyers we were getting. So we sold, say, for argument's sake, we sold 20. And then you managed to sell another 20. You managed to sell another 10 passively on the trade, and it drops, and you managed to sell 50 on the drop, and it drops again, and you managed to sell 100. And then you know you're now at the bottom edge, so you now get the rest of your trade on, and you say, right, let's whack in another 300 contracts here. And obviously at that stage, you're now marking down the price, aren't you? You don't think you're going to get the top edge, because if you thought you were going to get the top edge, you wouldn't have sold 300 contracts at the bottom edge. And obviously the market maker now recognises the markdown and says, right, they pull away the liquidity and off the price goes. So it becomes a cat and mouse game, doesn't it? It becomes literally a cat and mouse game where everybody's chasing that buyer, everybody's chasing the seller, whichever side you want to be on. So we're obviously, in this case, chasing the buyer. We want to find those buyers from somewhere. We know we'll get them at bottom edges, but we don't want them at bottom edges because we're giving away our price advantage. We're hoping that the value stays at bottom edges because there's a chance the value might disappear at the bottom edge. So the one thing we don't want to do is we don't want to end up with volume at the bottom edge and no value, because we've now got the worst case scenario for us. So we either have a good value still developing on the downside, in which case we sell those ones, which means it's called a markdown phase, which means it's time to go, and the price just breaks. If the value's gone bullish into the bottom edge, we simply don't sell them, and you get an exhaustion print at the bottom edge. And we know that at that stage, we might be able to spoof back into this to push the price back up through top edges into that 500 buyer at the top edge, and then we can sell into them. So it's a cat and mouse game. It all depends upon how the value is evolving. And it's about trying to figure out what you're going to do next in terms of those simple little narratives, isn't it? We can see that in all sorts of different markets. We can see it in the top edge of gold, for example, just in that last little series of trades. You can see just as we came into the gold market open here, the COMEX open, you can see that there was a lot of sell-side value starting to build here. Do you see it? Lots of sell-side value, top panel. A little bit of buy-side value still in here, so we're still concerned. So how are you going to get that volume? How are you going to get any business done? Well, the time of the day is actually quite good for getting volume, so that's a good bonus. But the idea is just keep the pressure on, keep the pressure on, keep the pressure on. And then you see we finally get the flip on the copper line. You see the copper line at the bottom edge finally flips just there. You can see a beautiful, beautiful flip on that line. And we get the volume you need. There it is. You get the volume you need. You get your sell on, and you're now short into that beautiful sell side value. You've now got a benchmark, haven't you? Because you've got the silver line giving you a sell, you've got the dollar giving you a sell, and now you've got the copper line giving you a sell. And the sell, well, goes 92s down to a low price of 97s, sorry, 02s going down to 97s for $500 on that little sell trade. So you put yourself in the position of the guys that are doing these little plays, and you ask the question, well, what would I do in this situation? How would I treat this situation? But it's always good just to get into a game zone. You know, get into playing a game with these markets. Think about what you would be doing. Think about how you would play this one. What would you be doing right now? Well, I'd be trying to buy into bottom edges. How am I going to buy into bottom edges? I'm watching for a little bit of a seller coming in to try and force the trade down into that bottom print price. And if I can get that trade down into the bottom print price, got a little bit of red value and a little bit of dollar value into that bottom price. Where are the sellers? They're obviously resting down here. So we've got a fair distance to go before we can get that guy on the books, right? So we start waiting. When we see the buyers coming back in, we say to ourselves, well, that's not going to work. I'm going to have to just take a play at that and try and get some money out of it. I'm going to take my shot. I'm going to take my shot. So guess what? We just took our shot. We've just got a quick trade on. Take a screenshot. I'll show you what we just did. Now, bearing in mind that we've just literally turned the gold screen on. But we can show you what happened. Okay, so there's the trade, right? So there's no real surprise that this trade went straight up, right? Because we just bought some trades, right? We just bought some gold. So you can see what happens. I mean, we instantly make profits every time, don't we? So why did we instantly make profits? Number one, we ran a little ledge. Do you see it? We ran a tiny little ledge in the background right there. So we got the kind of liquidity we were looking for initially. We jumped straight into the market when the book went bid. We jumped straight in, crossed the spreads by a tick. We made our money almost instantly. And you can see that little two lots just made $120, guys. That two lots just made 120 bucks. It's crazy, isn't it? How easy it can be if you just bid with an offer for stuff. The value was, the book was diverging. You can see that in the background. The book was diverging. So you can see that book itself is starting to just drag itself up a little bit into these low edges. So we had the kind of combination that we wanted. We found the right trade. We just bought into that candle there, as you know, and we looked for the context. So how would you get that context? We were watching the supply coming in. Well, we saw the supply coming in. Somebody was trying to get the sellers to come into the book, weren't they? Somebody was trying to force the price down through these phases here. So we knew that that was why we would sit waiting for the price to flip. Waited for the price to flip, run the stops, jumped on board, got the trade done, and made some quick cash. So the context is the most important, isn't it? Getting the context right in the right frame of reference means that a bid is actually bullish versus a bid that's actually bearish. So we could obviously start to understand that just order flow on its own can't allow us to make that decision. Order flow can never tell us whether the bid's a fake or whether the bid's real. We need to put it into the context of the rest of the charting, and that's when we can figure out whether we've got the right trade at the right price.